Good afternoon, everyone. Can you hear me? If you can please type in the chat. Excellent. So today we will be covering ESG investment. My name is Nadia Al-Gastab, and this is part of Capital Market Webinars in cooperation with Bahrain Bourse and collaboration with VIPF. So just a little brief about myself since we're starting. I have 15 years risk management experience. My last role was ABP Market Risk. And for the longest time, I was heading the market risk desk at BBK. And I have 300 hours of lecturing hours, mostly in sustainability. I'm a PRM accredited, and I am also MBA accredited. So the outline for today, we will be covering ESG investing, overall concepts. We will talk about what is ESG framework. We will talk about ESG investing. We will also touch upon the ESG integration macro and micro level, the changes that we have to do on organizational level to incorporate ESG, the principles of incorporating ESG issues in investment analysis, and finally, we will finish it off with investment mandates, portfolio analytics, and client reporting. Now, client reporting is divided into two concepts, which is accountability and alignment, and monitoring and measurement. So to start, I only thought it's fitting to explain the importance of ESG. Last year, we've talked a lot about the introduction of sustainability and what is ESG. But as bankers and as financial analysts, I believe we bypassed that stage. We do understand now, in a broad context, what is sustainability, which is to coexist on the planet, to make sure that resources are equal level for the next generations, according to the definition mostly adopted by the Bertland Commission. So just to start off, and a quick question for the audience. If I were to choose between two companies, which is Tesla and Exxon, which is a petroleum company, which company do you think is better ESG scored? Is it Tesla or Exxon? Can you type in the chat? Anyone? Tesla or Exxon? Any answer in the chat? Okay, so let's just talk about Tesla and Exxon. The obvious answer would be, just without knowing anything about sustainability or ESG, you would automatically think that Tesla is better scored than Exxon because it's an electric car company. What can go wrong? But in fact, if you look at the standard S&P 500 ESG index, you will realize that Tesla was actually voted out of the index, which caused a fury by Elon Musk, and he expressed his frustration when he made claims that S&P ESG index lost their integrity because of voting out Tesla while keeping Exxon in the index. Now, if you research in depth why that was done by S&P 500 index, it's because Tesla simply did not abide by health and safety regulations. They had incorrect transparency in the reporting, and internally they had discrimination issues within their workforce, which voted Tesla out in accordance with the ESG framework. And if you look at Reuters, previously Reuters, now Refinitiv data, sustainable investments, they account for more than a third of global assets, which means that the increased need for organizations to address all the sustainable requirements to give back to society. So organizations are starting to realize their contribution to the society and that they have to give back. But what is ESG? ESG is environment, social, and governance. And if we want to break that down further, ESG stands for environment, renewable fuels, greenhouse gas emissions, energy efficiency, anything related really to the environment and the climate. Water management. Now, social addresses diversity, employee benefits, human rights within the workforce, our responsibility to clients, and finally, governance, which talks about mainly ethical standards, board remuneration, board diversity, and mainly it talks about corporate governance, which is increase in transparency, in disclosure, improved reporting, and aligning ourselves better to the requirements of our stakeholders. So what is ESG investing? So in simple terms, ESG is a framework that I can use as an investor, as a company, as an individual to assess the company's performance with regards to E, S, and G, the environment, the social, and the governance. And it's a really breakthrough model because it allows you to look at things that financial institutions they didn't look at before. We are known as financial institutions that we're capitalist companies. We, according to Elton Friedman, the economist, that the sole responsibility of financial organizations is to maximize profit for shareholders. However, since in the 19th, a model was developed by John Ellington. Now, this model was called the triple bottom line. In that model, he highlighted that there are two other elements that are important for companies other than profit. Do you know what they are? Anyone can type in the chat? There are two other elements that as companies we do care about, and it's not just profit. Anyone wants to have a go in the chat? So the other two elements that we do care about is people and planet. And companies started to realize that it's really important for me to perform and to bring the profitability target. I have to care about the workforce that is delivering this profit and also the planet where my company is situated. So if you look at Fortune's snapshot here, most of America's CEOs, actually nearly 200 of these companies expressed that it is no longer the sole objective of the companies to increase their shareholder value or to attain profits. It's also to give back to society and also to ensure that the companies remain sustainable. Which, if you want to think about it, makes sense in light of the last scandals that happened in the past month itself, with SVP, with Signature Bank, recently Credit Suisse. All these companies are experiencing scandals and bankruptcies. Why? Because of unsustainable practices. So if we want to think about being sustainable, we have to also align it to the concept that we've been studying for the past 30 and 40 years. And being sustainable aligns perfectly with GAAP accounting rules, for example, going concern. Because as companies, we have to ensure we're going concern, which also now means going sustainable for the foreseeable future. So what is ESG investing? ESG investing, we have to make sure to incorporate all these ESG parameters that are non-financial in nature into our investment decisions. We have to make decisions. We have to talk to clients about these non-financial aspects as well. So ESG investing refers to responsible investing, giving something to society, but at the same time not jeopardizing the profitability of the companies to stay profitable in light of making socially responsible decisions. A wide variety of issues, they fall under ESG. Just like I said, usually under traditional investing, we do not consider them. And this is a breakthrough as well, because we are addressing the everlasting problem that we face as bankers and especially as risk managers. Because for the longest time, we could not manage the risks that we couldn't quantify. We couldn't talk about intangible things, non-financial aspects. But this model is one of the few models that allows you to incorporate the non-financial data as well. ESG builds on socially responsible investment, and you should be aware that socially responsible investment has been there for the longest time, as long as we can remember. Now, being socially responsible is nothing new. Actually started since the 1970s, when they started banks doing what's sort of called negative screening. Negative screening is not extending facilities for companies that deal with weapons and nuclear and, for example, drugs. So the only difference between ESG and SRI that ESG includes the ESG factors more in depth and detail. ESG also, investors, they believe that by incorporating these ESG pillars into the investment analysis, it will allow for better decision making and to protect us against risks that we might face because, for example, of climate change, reputational risks for lack of diversity, all of these things. So if we can include in our analysis non-financial data, we can better respond to the upcoming risks. Now, many people have been saying around that growth in ESG investing is just a bubble. But in fact, all bubbles, it is known in economics that bubbles, they're only there for a short period of time. For example, the real estate investment in the subprime, the bubble had burst. So bubbles usually do not stay as long as the ESG and SRI funds, they have been existing. Actually, if you go back, ESG and SRI funds, they've existed since the early 2000s, and they have gained momentum since 2017, and it's increasing till date today, which means by all means, it's not a new bubble and it's a growing in momentum. So ESG growth. Now we come to the main question and fundamental question that I believe you all logged in here today. How can we incorporate ESG into the day-to-day work that we are doing? Of course, this webinar is only for an hour, so I can cover the main topics of what is expected. And mainly, I will be focusing on the investment side rather than the other departments like risk and, for example, training. But ESG growth into the mainstream, there are three things that we should be aware of. And you should realize that these three concepts, materiality, transparency, regulations, they are not confined as a concept to only sustainability. Again, these concepts, they can pertain to any topic. We've studied it for the longest time. So if we want to take these concepts and tailor it to sustainability, the first thing that we would do is materiality. We would talk to our stakeholders and investors and highlight what are the sustainable issues But there are many issues that each and every firm faces. So we do not address the ones that are considered non-material. We only consider those material ESG risks that can impact the performance of the company in the long term. And that is done through a materiality matrix process. The second thing is transparency, greater transparency on how client money is invested. We are required in ESG to have more transparency, which is in line again with the governance pillar. And then finally, regulation. Up to today, we do not have a mandatory regulation for ESG and sustainability, but the regulation is increasing in momentum. And starting January 2024, the International Sustainability Standards Board will mainstream and unify all the sustainability regulations into one. So integrating ESG, macro level debate. So on macro level, what you have to do, there is this risk perspective. According to the World Economic Forum, if you open their website and open the global risk report, you will notice that in the long term, environmental risks, they have far bypassed economic risks that can impact the firm. Yes, if you look at the report, in the short-term horizon, risk is cost of living crisis, but in the long term, again, it's all environment risk. Then we have fiduciary duty perspective. This is the responsibility that you have as an investor or an asset manager towards the beneficiaries, that you have to protect the assets and the rights of the beneficiaries, these assets that you're controlling on their behalf. Economic perspective, as a financial institution or an asset manager, and even as a client, you should be aware that there is an economic changes that are upcoming in the society, for example, population growth, change in demographics, recessions, all of these things that they can impact the firm. And then the fourth one is impact and ethics perspective, and I find this to be particularly interesting. You see, mostly companies, what they do is they treat ESG and sustainability as another tick in the box. And we are again familiar with the basic concept of greenwashing because we've explained it so many times in the past 1 year. What greenwashing is when you introduce a sustainable product and it's not sustainable. So it's considered within a fraudulent activity. But the world have advanced, and what is happening nowadays is that companies truly introduce green products, but they are just ticking the box green products. They do not have a major impact. And that is called not greenwashing, that is called greenwishing. It's when you wish you're doing green, but the impact is very small. It's not considered a fraudulent activity, but at the same time, the impact of it is very low. So impact and ethics perspective, we have to make sure that the investments that we are investing in or we're introducing, they are impactful. They do make a difference. Then client demand and perspective, you should be aware that the clients now, the type of clients are changing. Clients are becoming more financially literate, and they are starting to realize that there is no difference between ESG investments and regular investments. So naturally, when it comes to profitability, so naturally they will opt for ESG investments in order to make a difference as well as the society. So the client demand perspective is also changing. And finally, the regulatory perspective, which I just told you about the ISSB and unifying the regulations by January 2024. So the regulatory perspective is definitely coming, mandates are coming, and once they get published and enforced, we have to integrate it on a macro level. So putting ESG into practice. So if we want to look at it micro level, and especially just an investment, what do I have to do? I have to amend my policy. I have to do shareholder engagement, and I have to do investment decision making. So incorporating ESG into investment, again, ESG investment is an approach to managing the assets, to explicitly acknowledge the ESG framework in their investment decisions. So this will enable the investments to become more profitable in the long run and to address any abrupt or sudden changes that might affect the profitability of these investments. Can you think of any abrupt situation that happened in the last 3 years that impacted the profitability of our investments? Anyone? Anyone? So I will just give you a quick one, which is COVID. COVID forced markets into a high wire turbulent behavior, causing most of the investment to go into the negative. So when we invest in ESG, and during actually COVID, we noticed that ESG investments, they did not react as volatile as regular investments. So while incorporating ESG into investment, we ensure as investors that we maintain our profitability and more resilience towards any shocks in the future. So why investors integrate ESG? Just to continue on the last point, there is regulatory fiduciary duties requirements. So when they come, we have to implement it. Client and beneficiary requirements, again, we explain that. And the third one is reduced investment risk. You see, as a financial analyst or as an asset manager, a banker, if you incorporate these regulatory requirements, you're less prone to penalties, to reputational risk, because you, from the clients, for example, generally less risk, hence reduced investment risk. Now, enhanced investment return is, in turn, it was noticed as per research that companies that have excellent corporate governance performance, they abide by the ESG framework, they tend to perform better on the long run in comparison to regular companies. And number 5, the world has evolved. They developed more analytical tools for investment professionals. So now we have many tools that can help us with the ESG analysis, such as ESG rating, such as, for example, ESG scorecards, and many other tools which we will be discussing. And finally, better engagement and stewardship. Now, what is better engagement and stewardship? Stewardship is when the investment or asset manager, they're responsible for safeguarding the assets for others. So we have to do careful management of financial assets for long-term benefit of the owners. So this is in line with my responsibility as a financial analyst to safeguard their investment. So to safeguard it, and when you come to the realization post-COVID that ESG funds are performing better, technically as part of your accountability, your stewardship, you should advise the client that these investments, they are performing better, they're giving back to society. So you safeguard their assets and encourage customers and clients to opt for these products. And the second thing is engagement. Now, engagement is the constant communication and dialogue with the managers and the board of companies regarding their stewardship, regarding how much they're giving back, for example, with sustainability, where do they stand with that. So challenges for investors in integrating ESG there are two phases for integrating ESG. One is prior to the ESG strategy, and the second one is post the decision to pursue ESG strategy. You see, we've struggled so much to change the concept that people have regarding ESG investments. There is one of the major challenges is a perception of negative impact on performance from ESG investing. Investors tend to think that ESG funds, they perform less, and according to research, that was proven contrary. And also the idea that ESG factors contradict the requirement of fiduciary, while in fact they complement it. So that also the idea is wrong. Poor financial advice is another challenge. And didn't you notice in the last 2 or 3 years, there have been an increased amount of training, of knowledge distribution, and that is even by regulators that was mandated. Why? To improve the financial advice given to clients. After the decision to pursue ESG strategy, the challenges that we might face is lack of understanding again, and I truly believe we are at this stage. We understand the importance of ESG, we understand that we require it, but how to implement it and what we do is where we struggle. To expectation that we need expensive tools and resources to assist us with the implementation of ESG internally. That might be true in the case of larger financial institutions. However, for smaller ones, we can outsource these data. And third, the gap between marketing and delivery of ESG performance. Sometimes asset owners are unsure of how these ESG performance are funds, and they do not communicate with the client with them. And the last thing is assessing the risk and opportunities of investee company, assessing the data availability, which most of the time is lacking, because what you will discover about ESG firms that there is no regulation forcing them to disclose data. Hence, most of the data is missing. So in order for me to assess a company, if they are ESG compliant or not, I will have to really struggle in finding all the data pertaining to the information they publish. Then modeling ESG factors, they affect long-term performance, but how to model them, because there's a lot of non-financial data concerning them. And finally, valuation technique, which they are under development. So types of responsible investment. So in order to include ESG into investment decisions, there are many types that I can incorporate it. One is being socially responsible, evaluating the companies with regards to social and environmental, or being sustainable, like selecting based on ESG factors. It can be ESG integration or screening. And screening is really important because the basic responsibility that we do as bankers is just screen the investments. And we have been doing negative screening for such a long time. But now we are required to do positive screening. So what is positive screening? Is to select green investments in comparison to regular investments. And best in class is selecting investments that in ESG criteria, they perform better than their peers. Then we have the third type of strategy, thematic, a sustainability-related theme. For example, climate change mitigation, clean tech. Then we have green investment that only address environmental challenges, social, which only address social challenges, impact, investing for financial return, for social and environmental impact, and ethical is, for example, religious restrictions. And finally, shareholder or corporate engagement, for example, when the ownership or shareholders, they influence the ESG related decisions that you would do. So according to the principles of responsible investment, if you must incorporate, and you should incorporate ESG into your decision making, you have to have the 6 voluntary principles. Now, notice the key word here, voluntary. They're not compulsory for you to follow. So the first one is incorporate ESG into investment process. To active ownership, seek the ESG disclosures by investee companies. And the third point is regarding the point that I mentioned previously, that we have a data availability problem. So usually by seeking ESG disclosures by investee companies, we seek to fill in the gaps of the lack of data. Promote implementation of these principles, and we work together to enhance the overall effectiveness of these principles. And finally, and most importantly, report on progress. We have to report on our sustainability progress to ensure that it's not just another tick in the box. Investment mandates, portfolio analytics, and client reporting. So we have to ensure in the last part that after we've done the investment principles, we know what is ESG framework, we have to incorporate it in our mandates, in our portfolio analytics. We have to be responsible when we're reporting it to the clients. So what does this framework entail? Accountability to clients, embedding ESG within mandates. We have to know what customers want from us as investment firms, monitoring delivery, and finally, measurement and reporting. So accountability, see, we have to be accountable to everything that we do, but with regards to sustainability, because it's such a moral topic, the accountability is much far larger than it is. And the thing with accountability that we are responsible for our clients, and in turn, also our directors are responsible to their shareholders. So there is an agency problem because all these stakeholders, they are interested in different time frames for the profitability of the firm. Some of them are interested in the short term, while others in the long term, and this creates an agency problem. So how do we address that agency problem? By 2 means, alignment and accountability. What is alignment? Is when we align the interests of both the client and the firm together. We have to sit here with the client and ask the client, what are you interested in? If you want an ESG fund, which part of ESG do you want to invest in? And as I mentioned before, there are many types. You can invest in social, in green only, which addresses environment, on a thematic investment. So there are many types. And at the same time, as an investment firm, I have many options for this strategy. So I have to make sure I align my interest with the client's interest. And the time frame should be agreed and the fees. Accountability, the manager must address the client's stated intention and report fully and regularly with the status of the investment. So there are 5 steps that we would do in light of what I said earlier. 1, clarifying client needs and objective. 2, aligning an investment with client beliefs. 3, developing ESG aware mandates, which are standards for the company to navigate through screening these investments. 4, tailoring ESG approach to client expectations. We have to make sure I'm delivering what the client wants, right? And number 5, holding managers accountable, which is very important. Now, accountability and alignment. So if I want to define it in the investment strategy, according to the Pension and Lifetime Saving Association, PLCA, they said there are 3 things that you need to do to incorporate it in your strategy. First, you have to be clear about your stewardship. You have to ensure that managers effectively integrate long-term ESG factors. and work with manager advisors on resources available for stewardship. So both the ICGN, the International Corporate Governance Network, and the PRI, Principles of Responsible Investment Investor Committee, they issued guidance, best practice. So the manager should implement the owner investment beliefs, integrate ESG issues into research and analysis, and invest constantly with the asset owner's time horizon to achieve their goal. Number 4, implement effective owner-aligned ESG-based stewardship, and this is all in line with what we said previously. Engage constructively and productively with policymakers, and when we say policymakers, there are some regulators that did not announce. For example, ESG regulations. We take the international ESG regulations in this case. Then report on actions taken and outcomes achieved. So McKinsey also highlighted 6 methods for including it in the owner approach. They are similar to the PRI and ISGN. It just framed in a different context. But all in all, if you look at it, I'm not going to go through it, but I just want to show you that most of the regulations out there, they address the same steps. Hence, ISSB will streamline all of these regulations in January 2024. Now, ESG and mandates, what the portfolio manager action should do. You see, there is a policy that we have. We also have to amend our internal policy. So in the policy, we have to write the ESG issues, what is considered as policy reviews. We have to write the portfolio impact, the exposure to risk, okay? And the implication of the decision-making process, how internally in the organization I assess ESG, because I also have my own analysis that I'm doing. So I have to, in the policy, write my own methodology, how I'm incorporating ESG. So annual and interim reports to investors should include ESG information, how I'm calculating it, engagement and outcomes. So all of these things should be detailed in a policy and in regular reporting. So the evolution of ESG integration, the simplest approach to ESG investing is screening. So if there is anything to take from the webinar today, please take with you this idea that the place that we need to start is screening. So how do you screen? The first methodology that we have been doing for the longest time is universal. This started since the 1970s. These are exclusions. Such, for example, the United Nations and the World Health Trade Organization bans the type of weapons, for example. Then we have conduct related. We do not deal with companies or investments that are violating, for example, labor law. Faith-based, for example, religious exclusions. For example, I don't deal with alcohol or pork. Idiosyncratic, which is specific to the organization itself. These are exclusions not supported by global agreements. They are specific to the country itself or the company itself. For example, like pension funds in New Zealand are prohibited by law from investing in whale meat. So client requirements, what the client requires. Now the client is very easy, what do they require, right? They require to know your process. So when you are reporting regularly how you calculate ESG, and even when you include ESG, for example, in your contracts and your covenants, these clients, they tend to realize what is important for the financial institutions, for the asset managers. So how does that process apply to specific securities? And we have different investment securities, so you should mention how you evaluate ESG with regards to equities, bonds, ETFs. So you have to be very clear how you're treating each type of asset class. So this analysis allows to better understand how the firm will select, weight each asset, and it will also help clients to choose you because they will align themselves to the company that is being very transparent about how they're selecting and how they are calculating these ESG parameters. And what clients also want from these companies is constant engagement. And that is also the case in regular investments. They do want constant communication regarding any changes. Now, the constant communication frequency will differ based on the client interest. If the client interest is long-term, so the asset manager or the investment company does not have to contact the client frequently, whereas if it's short-term, we have to contact them more often to explicitly report the progress. The last stage is monitoring delivery and measurement. So monitoring delivery, as I said, more frequently depending on the strategy, but regularly on the normal reporting would be annual. But it depends on the client request, whether he wants it frequency, depending on his strategy or his concerns. Monitoring delivery. A performance benchmark can be relative based on the market, or it can be absolute. Now, the most common way I can monitor my fund or investment is in comparison to the market. Assessment of ESG performance, we have to always do our due diligence. We have to ask ourselves these questions. For example, how does the firm operate? Specific sectors and categories. Regarding the E, S, and the G, we have to investigate, and asset classes, as I told you, we have to investigate how the ESG is calculated in regards to fixed income, sovereign bonds, property, and so on. Now, measurement and reporting. Measurement and reporting is one of the most interesting and highly disputed topics in the COP27, because one of the main measurement and reporting methods of ESG performance is ESG ratings. And as you're aware, ESG ratings now, we have many companies to report ESG ratings is Sustainalytics, MSCI, Moody's, Bloomberg. The problem with ESG ratings that you cannot take them as full value, face value. Why? Because you will see one company, for example, Adidas, is being reported differently by each rating agency. So you cannot consider that rating at face value because each company calculates the ESG framework on their own methodology, given different weights for each pillar. Mostly in financial organizations, we give higher weight to governance. So rating agencies, they capture different data points. Each agency deploys different set of values. And usually they are the opinions of the analysts and priorities. And you don't see these differences in the regular rating agencies when they are rating the traditional investments. The traditional rating agencies, Moody's, Fitch, and Standard & Poor's, they're very much streamlined when it comes to traditional investing. But the conclusion that they came with after COP27, that they will also streamline the ESG rating. So that is an expectation that will happen hopefully in the future. So institutions turn to a variety of entities when it comes to evaluating the ESG. So how do I evaluate investments? I can go to ESG ratings like MSCI, again, Sustainalytics, the third-party analytics, company reports, anything that is published by the company, non-government organizations, publications, outsourced consultants, news and media, and regulatory findings. And one impressive thing about this chart is most of the dependency is on ESG rating, although we've mentioned that we cannot depend on ESG ratings at face value. We should be analyzed in depth to see how it's being calculated, if it's aligned with our company strategy and the client investment strategy. So, although it is not that credible, it is the most widely used, so it says a lot about the other sources and the other tools. So while you go to the right, the less credible these sources they become. So measurement and reporting, PRI signatory firms at the last step, and I want to leave you with this note. What do we have to do? We have to benchmark our investment progress against industry framework. It should not be another tick in the box. To receive feedback and tools for improvement, any opportunity to improve the feedback and tools, we have to seize it. To benchmark performance against our peers. To understand the state of the market, we have to see the big picture. We have to understand that ESG incorporation is not just another project that we have to do and end it with. It has to serve a major sustainable change. To build ESG capacity by strengthening internal processes, and in order to incorporate it, we have to change our model, our internal processes, and strengthen them. One of the main pillars of strengthening the internal processes is training and development. And the last thing, to summarize activity to stakeholders, because sustainability, if you see, it's based on engagement and communication, open dialogue. So while you keep this open dialogue, you tend to summarize these activities for stakeholders and to report the progress on ESG performance, which holds you and them accountable for any deficiencies when it comes to sustainability. So one prominent question before I leave you today, which I will start asking the question before I leave you, is that what happens if a company is not performing in ESG and have already invested in it? See, the first thing that you would do is you would open a line of dialogue with the company, asking the company to give you the information of their progress towards ESG. And if you notice year by year that this company is not performing when it comes to their ESG criteria, then you will start the divestment process in which you will decrease your investment in that company and close off the investment. So I hope you enjoyed the webinar today. I really wish that I delivered something of value. If you have any questions, please type in the chat. I'm more happy to answer any question. Any questions, everyone? Fatma, is there any questions? Is there any questions? Thank you, Debbie. Thank you for joining me today. I really appreciate it. So I believe there are no more questions. So let's connect on LinkedIn. If you have any questions, shoot them there and I will be more than happy to answer them. Thank you for joining me today. It was a pleasure having you. Thank you very much, everyone.